Welcome to the deep dive. Okay, let's just jump right in. Federal income tax, it works on this pay-as-you-go system, and today we're really zeroing in on estimated taxes. This deep dive is for you, the listener, to kind of figure out if this applies to your own financial situation.
Exactly. It's helpful to think of it maybe like this. There are really two main ways the IRS gets paid throughout the year. Most folks know about withholding, from paychecks.
Right, the standard way.
Yeah. But what we're diving into today is that second method, actually making estimated tax payments yourself.
Right, and we've gathered some key info, pulling from official tax resources to really unpack who needs to pay these estimated taxes, and maybe more importantly, when those payments are actually due. It really boils down to understanding the rules so you can hopefully avoid any penalties.
And yeah, trust me, those penalties, maybe not huge amounts always, but definitely something you'd rather just not deal with. So let's start right at the beginning. What are estimated taxes? Like fundamentally.
Okay, let's unpack that. So basically, estimated tax is how the government collects tax on income where there isn't any automatic withholding happening. It's kind of like you're filling in the tax gaps yourself, the ones your regular job isn't covering.
That's a good way to put it. So what kind of income are we talking about here? Stuff that isn't typically withheld?
Oh, the list is, well, it's pretty broad actually. If you're self-employed, freelancer, running your own business, this is almost definitely something you need to think about.
Mm-hmm. Big category there.
Yeah, but it also covers things like interest you earn, dividends from stocks, alimony if you receive it, rental income from property you own.
Landlords, yeah.
Right. Profits from selling assets, capital gains, so stocks, maybe real estate, even like hitting the jackpot with prizes or awards. Basically, if you've got money coming in and tax isn't being taken out right away, estimated tax might be in the picture.
And it's important to remember this isn't just about the regular federal income tax. Estimated tax also covers self-employment tax. That's your Social Security and Medicare if you work for yourself, and potentially even the alternative minimum tax, the AMT, for some people.
Okay, and here's something that really caught my eye. You could actually be expecting a tax refund when you file your big annual return,
Right.
but still get hit with a penalty if you didn't pay enough estimated tax during the year and on time. So thinking you'll get a refund doesn't mean you're automatically off the hook.
That's such a critical point. People miss that sometimes. Okay, so let's get down to brass tacks. Who generally has to pay these? We touched on self-employed, but let's get more specific.
Absolutely. So yeah, if you operate as a sole proprietor, if you're a partner in a business partnership or a shareholder in an S corporation,
Hmm.
or just generally self-employed, you're, let's say, in the high likelihood zone. But ultimately, it really hinges on whether you meet a couple of key financial thresholds.
That's right. The general rule for most people anyway comes down to two conditions. First, you have to expect to owe at least $1,000 in tax for the current year. And that's after you subtract out any withholding from jobs and any refundable credits you might get.
Okay, $1,000 threshold, that's the first piece. What's number two?
The second part is you expect your withholding plus your refundable credits to be less than the smaller of two specific amounts.
Okay, smaller of two.
Right. Either 90% of the tax that's going to be on your tax return for the current year you're in, or 100% of the tax that was shown on your tax return for the previous year. But there's a little catch there that prior year return has to have covered a full 12 months.
Got it. So it's kind of a comparison, looking ahead at this year, but also looking back at last year. A bit of a balancing act. And you mentioned, I think, that those percentages, the 90% or 100%, might be different for certain people.
Yes, that's correct. If you're, say, a farmer or a fisherman, or if your income is higher, over $150,000 generally, or $75,000 if you're married filing separately, those percentage rules can change, specifically that 90% rule. So definitely worth double checking the specifics if you fall into one of those groups.
Good detail. Okay, what about this? Say someone owed extra tax last year because their job just didn't withhold enough money. Does that affect their estimated tax situation this year?
It absolutely can. Yeah, if you had an underpayment last year because withholding wasn't enough, the IRS might kind of expect you to start making estimated payments this year to, well, avoid that happening again. It's sort of a flag that your regular withholding might not be cutting it for your total tax bill.
Makes sense. A signal to adjust. Okay, so let's flip the coin. Who generally does not have to worry about estimated taxes?
Well, the most common group are people who are mainly employees, getting regular salaries and wages. If almost all your income comes from a job with withholding, You can usually skip estimated tax just by adjusting that withholding from your paychecks.
Ah, the trusty Form W-4. How does that play into this?
Exactly. If you think you might owe more, or maybe you start a side gig, you can just give your employer a new W-4 form. There's a specific line, line 4C, where you can tell them to withhold an extra flat dollar amount from each paycheck. It can be a really simple way to cover taxes on other income without having to make separate estimated payments.
So just tweaking your W-4 could solve the problem. Smart. Are there any other situations where someone's just completely exempt?
Yes, there are three specific conditions. If you meet all three, you generally don't have to pay estimated tax for the current year. First, you had zero tax liability last year, meaning your total tax was $0, or you didn't even need to file a return.
Okay, no tax last year.
Second, you were a U.S. citizen or resident for that entire prior year.
Right.
And third, that prior tax year covered a full 12 months.
Gotcha.
Check all three boxes, and you're likely clear for estimated taxes this year.
Okay, good clear rules there. Now, life happens, right? Things change. I imagine certain events during the year could suddenly mean someone does need to start thinking about estimated taxes, even if they didn't before.
Oh, absolutely. You're spot on. Changes in your life, your finances, they can definitely trigger this need. It's really crucial to be mindful of those shifts.
So, what are some of those key life events, things that should put estimated taxes, on our radar?
Well, a big one is taking money out of pensions or traditional IRAs. Sometimes the tax withholding on those distributions isn't enough, so you might need estimated tax to cover the rest. Any big change in income, really a big raise, or even losing income if it affects your deductions, that can change your whole tax picture.
Okay, retirement income, income changes.
Yeah, starting a new job, losing one, getting married, getting divorced, dependents changing, even hitting certain ages like 59 and a half or 73 that affect retirement account rules. All potential triggers.
Wow, okay, that's quite a list already. Anything else?
Oh yeah, selling or buying a business or even real estate, that can create significant tax events needing estimated payments. Retirement itself often means your income shifts away from wages with withholding. Getting a notice from the IRS about a past issue might mean you need to be more proactive now. Becoming self-employed, like we talked about, that's a huge one. And even making large charitable donations of property, sometimes that can impact things too, especially over $5,000.
It really sounds like any Niger financial move or life change deserves at least a quick check on your estimated tax situation.
Okay, let's talk timing, the calendar. When exactly do these payments need to be made for 2024? Right, for 2024, the year's split into four payment periods. Each has its own deadline. The first period covers income from January 1st to March 31st. That payment is due April 15th, 2024.
Okay, tax day for the first one. What about the second quarter?
Second period is April 1st through May 31st, and that payment's due June 17th, 2024. Then the third period covers June 1st to August 31st, and the due date is September 16th, 2024.
Okay.
And finally, the fourth period runs from September 1st through December 31st. That payment is due January 15th, 2025.
So generally mid-month after the period ends. Got it. But I saw a note, something about a special rule for that last payment, the January one.
Yes, that's a helpful little exception. You actually won't get penalized for underpaying that fourth installment if you file your 2024 tax return and pay the full remaining balance by January 31st, 2025.
Ah, okay.
So it gives you a bit of extra time, like a 2-week grace period, basically, if you file early.
That could definitely be useful. And there was also something about state estimated taxes, paying the fourth one a bit early.
Right, so we're mostly talking federal here, but it's related. If you pay state estimated taxes and you usually itemize your deductions on your federal return,
Hmm.
paying your fourth quarter state payment by December 31st, 2024, instead of waiting till January 2025, might let you deduct that payment on your 2024 federal return. It's a bit of a timing strategy for itemizers.
Good tip for people who itemize. Okay, so someone figures out, yep, I need to pay estimated taxes. How do they actually do it? What are the mechanics?
There are actually several ways, pretty convenient options mostly. I guess the old school way is using Form 1040 ES. It's a voucher. You fill it out and mail it in with a check or money order.
Okay, mail still works. What about more modern ways? Online?
Oh, definitely. You can pay online right on the IRS website, irs.gov payments. You can use your checking or savings account, totally free. Or you can use a debit or credit card, but just know there's usually a small processing fee if you use a card.
Right, the card fees.
They also have a mobile app, IRS2Go. You can make payments through that too from your phone or tablet.
An app, okay. Any other digital options?
Yep, there's the Electronic Federal Tax Payment System, EFTPS. It's a government system, pretty robust. You can schedule payments in advance, see your payment history. It's quite useful, especially if you pay regularly. You enroll at fps.gov.
Okay, so lots of ways to get the money to them. And is it always one big payment per quarter, or is there flexibility?
Great question. No, you don't have to pay it all at once on the due date. While the deadlines are quarterly, you can absolutely pay more frequently if that helps your budget. You could pay weekly, bi-weekly, monthly, whatever works for you, as long as you've paid enough by the quarterly deadline.
That seems much more manageable for managing cash flow. Good to know. Now, inevitably, what happens if someone messes up? They don't pay enough, or they miss a deadline. We mentioned penalties earlier.
Right, penalties, they can happen if you don't pay enough tax during the year, either through withholding or these estimated payments. But there are ways most people avoid them. Usually, you're okay if you owe less than $1,000 in tax when you file your return after all the withholding and credits.
Okay, under a grand, usually no penalty.
Or if you paid at least the smaller of two amounts, 90% of the tax for the current year or 100% of the tax shown on your prior year's return. That's the same rule we discussed for who has to pay.
Right, that 9100 rule again. Okay, so those are the main ways to avoid it. Are there ever situations where the IRS might just waive the penalty even if you technically underpaid?
Yes, there are a couple of specific exceptions. The IRS might waive it if the failure to pay on time was because of a casualty, like a natural disaster, or some other unusual circumstance where imposing the penalty would just be unfair.
There are unforeseen events.
The other main situation is if you retired specifically after reaching age 62, or if you became disabled during the tax year you owed the payment for or the year before. And critically, the underpayment has to be due to reasonable cause, not just, willfully ignoring it. You typically file a form to request the waiver in these cases.
Good to know there's some recourse for major life events like that. Now, our tax system loves complexity. Are there any other taxes people might need to roll into their estimated tax calculations besides regular income tax and self-employment tax?
Yes, good point. There are a couple more usually affecting higher income folks. One is the 0.9% additional Medicare tax. This applies to wages, certain railroad retirement compensation, and self-employment income above certain thresholds, which depend on your filing status.
Okay, additional Medicare tax for higher earners. What's the other one?
The other is the 3.8% net investment income tax, or NIT. This hits basically the lesser of your net investment income, things like interest, dividends, capital gains, or the amount your modified adjusted gross income, your MAGI, exceeds certain thresholds.
Okay, MAGA. That's like your adjusted gross income, but with some deductions added back in, right?
Exactly. It's specific calculation. So if you have significant investment income and higher overall income, NIT might apply and need to be factored into estimated payments.
Makes sense. So what are those income thresholds we're talking about for these two extra taxes?
Okay, for the additional Medicare tax, the threshold kicks in above $200,000 for single, head of household, or qualifying surviving spouse filers. It's $125,000 for married filing separately. For the net investment income tax, the MAGI threshold is $250,000 for married filing jointly and qualifying surviving spouses. It's $200,000 for single and head of household, and again, $125,000 for married filing separately.
Right, so those 200K and $125K figures pop up for both taxes, depending on how you file. Good numbers to be aware of. Okay, as you start to wrap this up, I think it's really, really important we add a disclaimer here.
Absolutely critical. Look, the information we've gone over today is for general understanding, right? It shouldn't be your only source. Tax laws can change, and everyone's situation is unique.
Exactly. So what's the main takeaway? If someone's listened this far, what should they really remember about estimated taxes?
I think the core message is this. If you have income that doesn't have taxes withheld automatically, understanding estimated taxes is just crucial. It's how you stay compliant throughout the year, meet your obligations, and importantly, avoid those potential penalties when April 15th rolls around.
And it really sounds like being proactive is key, paying attention to life changes, income shifts.
Precisely. Those changes can really impact your tax situation. Staying on top of whether you might need to pay estimated tax is just part of sound financial management, really.
Okay, so our final thought for you, the listener. Given how complex taxes can be and how unique your own finances are, just taking a moment to think about any income you receive where tax isn't automatically taken out. Well, it could save you some headaches, maybe some money down the road. Perhaps just making a quick mental list of those income streams is a really good next step. Thanks for joining us for this deep dive.